Hey guys, Dylan Yancey here, and I chose how media can portray the stock market. So there's two types of media that I chose. The first one is social media, and that can pertain to, but not limited to, Twitter, Facebook, Instagram, and etc. And the second type of media is television. And some of the programs that focus on stock market are Mad Money, Money Matters, the Bottom Line, and also etc. So some of you are thinking right now, what is stock market? You probably have a basis know that people buy stuff and people also get money in return when they sell their stock. Well, I'm going to give you like a little background knowledge on the stock market. So a stock market exchange is built up of at least 1,200 businesses that allow you to share. And exactly what a share is part of your business, of their business, that you are willing to buy with money or any kind of currency. So say that you buy a share and that share is worth 2%. Picture it as a pizza and the business is the pizza. As long as the business keeps growing and growing, the bigger slice of pizza that you get. And since this is happening to a lot of the companies, like Facebook, ever since Facebook has gone public with their company, they have grossed $16 billion just in the stock market. Now, you're probably wondering why businesses do this to get all this money. Well, they do this because it's not just only for the money, they do it to also grow their business and to build on top of it and to make their business even better. Okay, so now you have a background knowledge on the stock market. I'm going to focus in on the social media aspect of it. First, you have Office Twitter. And Twitter is a major one because you can tweet small little things about stocks that are very helpful to other people. Some of these accounts contain as CNBC, Benzinga, and New York Times Business. Facebook also has a big one called Market Watch, and they also have daily updates, stuff like that. Instagram posts pictures, so you can obviously imagine that Instagram can post pictures of the actual stock and what it's going to be doing or what it's going to be possibly doing in the future. And these Instagrams, some of the famous ones are Quick Cash and Rocket Baxter. So the timeline of Facebook and Twitter goes like this. In 2004 in January, Facebook launches and acquired its 1 millionth user in December 2004 in the same year. And on September 2005, Facebook launched the high school version of the website to incorporate the younger crowd and attract the younger crowd. And in March 2007, Twitter launches. In August of 2007, the Twitter introduced the famous hashtag. Twitter in 2009 also allows advertising, which is a big boost in the stock market for Twitter. Now I'm going to show you guys a interview that I found on Bloomberg about how social media is a very high key point in stock markets today.
Two values that social media provides over traditional equity research. The first is the real-time nature. And financial markets, probably more than any other market out there, are more conducive to real time than anywhere else. The second is that social media is all about engagement and debate and discussion and disagreement. And when you have that, and you have that context, it's something that traditional analysts can't necessarily.
Yeah, it's very different than, okay, here's my target on the S&P, here's my price target on eBay. In this case, it's a back and forth with lots of commentary.
Exactly. Socratic debate wins.
So what is
Well, there you go. He says it right there. Real time is the most important thing about social media. People want to know what's going on right now. Facebook's stock profile on a constant rise since it went public in 2012 of what actually is going on. Social media positives. The relayed information is on real time, as said in the interview. And social media can also reach out to large amounts of people because of retweeting and following certain people that you might like to listen to about the stock market. Social media negatives, though, are false statements. Some people will get on the bad end of the stick and get paid to say something bad about another company because they have a lot of viewers, which is also and that's something that are getting paid to say most likely won't be true. Another thing is called flip flop economics, and this is about the bad rep that one company can get, and then its opposition could perform better from this. My next social media is television. Television programs can include Mad Money, Money Matters, The Bottom Line, and way more of these constantly feed the market on the bottom of the screen, as you may have seen before. Television positives are personal opinions. You can look into the insight of another person and see what his thinking is about. And also the detail of television. The detail of say, let's say a tweet is only 140 characters, whether on detail of television you have 30 minutes to an hour, maybe even more, talking about one stock if they want to. The television negatives, though, is the time delay. Referring back to the interview again, social media is on the real time basis and can send a tweet in less than 5 minutes. On television, there's long delays between editing and getting back on the show for the next program. Also, a negative through television is it's not mobile. So today we learned two types of media that can portray the stock market: television and social media. They both get the message across. What may not be whether they're in the same time increments, but they both get the message across. However, those two different things that is very important is real time and delayed time. Reference page speaks for itself. See you guys later.